Hi, this is Ken Boyd with the Accounting Accidentally website. This is our home page. You'll see the blog with over 300 blog posts. And if you scroll down toward the middle of the page, you'll see links to over 400 accounting videos. In this video, I'd like to talk about the effective interest rate, which is a method used to account for bond expenses and bonds income on investments that aren't bought at face value. So this particular slide talks about discounts. The next tab talks about bonds bought at a premium. So what does a discount mean? The buyer pays less than the par amount or the face amount of the bond, and that's the amount stated on the bond certificate. In this case, the face amount of the certificate is a $500,000 bond, but the investor only pays $377,107, which is the number you see over here. So the effective interest rate method is intended to be a more precise way to measure bond interest if you're an investor, bond expenses if you're a borrower, than just the straight line method. And a key point here is that if you buy a bond at a discount, the carrying amount, which you see in this column, increases up to the face amount over the life of the bond, which in this case is 10 years. So years, 10-year life, we buy it at $377,107 as an investor. It increases, the carrying amount increases up to $500,000 over the 10 years. So if you're recognizing expenses as the bond issuer, that's one side of the transaction. If you're recognizing bond income as an investor, that's the other side of the transaction. This assumes that we're earning interest as an investor. So these columns are really the key to the whole thing. And another important point before I start going through the numbers is yield to maturity, which is a way of thinking about the total return you earn on a bond as an investor. Part of that is the interest you earn along the way each year, in this case 6% interest. But an investor who buys a bond at a discount also earns the difference between the price they pay for the bond and what they get at maturity. So in this case, roughly $100,000 and close to $30,000 is the difference between carrying amount and what you get at maturity. That is part of the total return on the bond. So I always recommend that if you're in an intermediate accounting class or doing CPA exam, that you set up the problem in this way. So you're going to get 6% on $500,000 or $30,000 in interest each year, and that's a fixed amount, obviously, stated on the certificate. Many test questions will say the bond is, quote, purchased to yield a certain percent. In this case, I made it 10%, which means that we're going to take the carrying amount of the bond and multiply it by 10% to figure out what the interest income is using the effective interest rate method. So if I click on this cell, you'll see that in blue it's $377,107 multiplied by 10%. Our interest income is $37,710, which means that we have a difference between interest earned in green, interest income in blue, and we call that the discount amortization. That amortization increases the face amount of the bond. So I have a column for the unamortized discount, and you can see that the unamortized discount falls as the carrying amount increases. So that $7,700 roughly reduces the unamortized discount, blue minus green, and it increases the carrying amount. So you see a carrying amount increasing by that amount. You see the unamortized discount decreasing by that amount. What we'll see on the next video is how all of the discount eventually ends up in the carrying value column, and we'll also see the journal entries that are made to account for this activity. Also wanted to mention that if you can go to Conference Room, the feed here at this address, and click on courses, you'll see that I'm starting to offer courses on different accounting topics. You'll quickly see these being offered on the site. You can come here to get live training in accounting. Thanks very much for watching, and we'll see you next time.